Kia ora, and welcome to Monday's Economy Watch, where we follow the economic events and trends that affect New Zealand. I'm David Chaston, and this is the international edition from interest.co.nz. And today we lead with news. The economic world is returning after the end-of-year holiday season and finding 2024 worries are still here in 2025. First up, however, the post-New Year holiday week back will be a relatively quiet one, but there are still some important things to cover, and a few of the key ones are local. But the week culminates with the December US non-farm payrolls report, and that will increasingly dominate how the week goes. Markets currently expect a modest 150,000 rise in US jobs. That is close to average over the past 10 years. But don't forget, that is the seasonally adjusted result. Actual payrolls shrink in the month usually, and that average over the past 10 years is by 160,000. That is what we'll be watching, because fewer actual people employed could have an outsized impact on metrics like retail sales and the like. The US will also release December services PMIs. A slightly softish expansion is expected. And China will release its important new yuan loan data, and the expectations are for another weak result. Eyes will also be on India's industrial production data, something that has been softish recently. Just as important for us, we'll get more December real estate activity data this week. We'll also get another full dairy auction on Wednesday, and the intervening pulse results for both skim milk powder and whole milk powder have shown a marked softness since the last full auction report. And Barfoots are likely to release their December results later in the week. Over the weekend, the FAO World Food Price Index reported a 0.5% fall in December from an upwardly revised November. Dairy prices fell 0.7%, but meat prices rose 0.4%. Overall, this index is 6.6% higher than year-ago levels, with dairy up 17% and meat up 7% on that annual basis. And staying on the commodity front, both lithium and iron ore prices slipped on concerns about prospects for the Chinese economy. The Shanghai Stock Exchange fell yet again by 1.6% on Friday to be down a very sharp 5.5% for the week. And the benchmark yield for Chinese government bonds slumped to a record low of 1.60% for their 10-year. The yuan fell, testing its lowest levels since 2007, after their central bank stopped defending the yuan at 7.3 to the US dollar. So China is ramping up its subsidy program for consumer durables, trying to spark some extra consumption activity. And China's central bank said late Friday, during a quarterly meeting of its Monetary Policy Committee, that it'll cut banks' reserve requirement ratio and interest rates at the proper time. So China is starting the new year on the back foot. Across all reporting countries, the global factory PMI contracted slightly in December, shifting from a slight expansion in November. Good expansions in India, Taiwan, Canada and China, amongst 8 others, was offset by more retreats in the US, Australia and especially Europe, amongst 7 others. On balance, it was a soft new order levels that is turning the global tide. In the US, a good rise in new orders saw the widely watched ISM factory PMI rise in December from the previous month to record only a very minor contraction, and very much better than was expected. The result reflected the softest pace of contraction in the US manufacturing sector since March. Oddly, the narrative for the internationally benchmarked S&P market PMI was the inverse, with weaker new orders and slipping output. However, both surveys landed at the same spot, reporting a very minor contraction. And US vehicle sales ended the year on a strong note, running at a 16 million annualised rate. Electric vehicle sales accounted for 9% of those, and a surge in demand for EVs helped heavyweight General Motors claim the top spot for all cars and are only second to Tesla in electric vehicles. Tesla slipped back in the final quarter. And over the weekend, 2 Fed governors both reiterated that the battle to control US inflation is not won yet. Another was more positive, but still thought restrictive rates should stay in place until things are clearer. In Canada, their factory PMI delivered a solid performance with good new order levels and rising output contributing to a rising expansion. In Australia, southeast New South Wales and northeast Victoria have been hit by a heat wave, with temperatures as high as 45 degrees. but a wind change has relieved things today. Bushfire season is well underway there. Containerised freight rates rose marginally last week, up 3% overall, built on a 7% surge on the Trans-Pacific rates from China to the US West Coast. Traders are trying to beat what are expected to be new tariffs from the incoming US administration. Bulk cargo rates stopped falling last week though, essentially holding at an 18-month low. And the US Treasury 10-year yield is now just on 4.60% and up 1 basis point from Saturday. The price of gold will start today at $2,639 an ounce, and little change from this time Saturday. Oil prices are also unchanged from Saturday, just on $74 a barrel in the US, while the international Brent price is still at $76.50 a barrel. Both are up $2.50 since this time last week, though, and at a 2-month high. And the Kiwi dollar starts today at 56.1 US cents and unchanged from Saturday, but down 20 basis points from a week ago. Against the Aussie, we're down 10 basis points at 90.2 Australian cents. Against the euro, we're also down 10 basis points at 54.4 euro cents. That all means our trade weight index starts today at just over 66.8 and down 10 basis points from Saturday, but essentially unchanged from a week ago. And the Bitcoin price starts today at $98,070 and up 0.1% from this time Saturday. Volatility over the past 24 hours has been low, at just on plus or minus 0.8%. You can find links to the articles mentioned today in our show notes, and you can get more news affecting the economy in New Zealand from interest.co.nz. Kia ora, I'm David Chaston, and we'll do this again tomorrow.